If you want to achieve profitability and minimize your losses in the market, this 5-step test of price action trading is an excellent framework to follow. By consistently applying these steps with discipline, you can gain the confidence and skills needed to succeed in the market. Don't miss out on the opportunity to improve your trading strategy and increase your profitability. Follow these steps and watch as your trading success grows rapidly. Whether you're a day trader, swing trader, or investor, this approach will help you make more informed trading decisions and avoid costly mistakes. Although it may take some time to get used to the process, with practice, the ability to quickly assess whether a trade is worth executing or not will become second nature to you. This skill will make you an efficient and profitable trader. So, let's get started. Step number 1. The trade setup. The setup represents the fundamental conditions that must be met before you even consider making a trade. For instance, if you're a trend-following trader, then a trend must be in place before you can think about taking action. Your trading plan should clearly outline what constitutes a tradable trend for your specific strategy, which will help you avoid making impulsive trades when a trend isn't present. Essentially, the setup is your justification for trading. To illustrate, consider this chart as an example. The chart shows a downward price movement, characterized by lower swing highs and lows, as well as the price being below a 200-day moving average. Your trade setup may vary, but it's essential to ensure that market conditions are favorable for your specific trading strategy. Remember, if the conditions that justify your trade aren't present, then it's best to refrain from trading. But if your trade setup is satisfied, then it's time to move on to the next step of the 5-step price action trading strategy. Step number 2. The trade trigger. The trade trigger refers to the precise moment or event that signals it's time to enter or exit a trade. Identifying the trade trigger is an essential part of the 5-step price action trading strategy, as it helps traders pinpoint the optimal time to execute their trades. By waiting for specific price patterns or signals, traders can increase their chances of success and minimize their risk. The trade trigger is a critical component of any trading plan, and mastering this step is key to achieving consistent profitability in the markets. So, once you've identified a favorable trade setup, the next step is to pinpoint the exact moment to enter the trade, or the trade trigger. While a trend may be present, there will be certain moments within that trend that provide better trading opportunities than others. As a price action trader, you'll be looking for specific price patterns that signal the optimal time to enter or exit a trade. In this example, the price is in a downtrend, but there are specific triggers that tell you when to sell. Price action traders typically look to sell after a new low or high is formed, following a pullback to a resistance area. The bearish pin bar pattern that follows, along with a break below the consolidation area, provides confirmation of the trade trigger. By waiting for these specific signals, you can increase your chances of success and reduce your risk of entering a losing trade. The trade trigger is an essential component of the 5-step price action trading strategy, and it's crucial to master this step before moving on to the next. This particular case in the Euro's United States dollar downtrend highlights 3 potential trade triggers, which may vary depending on the specific trading strategy being employed. The key is to identify the trigger that aligns with your trading plan and provides a high probability trade opportunity. First, one possible trigger is a consolidation area on significant resistance. The trade is initiated when the price moves below the consolidation area's low. Second, another potential trigger is a bearish pin bar pattern at a resistance zone. A short position is initiated when the bearish pin bar closes below the resistance zone or consolidation area. Third, the third sell trigger is a rally to a new low price following a pullback. Before executing a trade, it's crucial to ensure it meets the necessary criteria by going through steps 3 to 5 of the 5-step price action trading strategy. The trade trigger allows traders to pinpoint their entry point in advance, providing ample time to assess the trade's validity before taking it. Step 3. Managing risk with a stop loss. Simply having a trade setup and a trade trigger is not enough to ensure a successful trade. Effective risk management is also crucial, and one way to do this is by using a stop-loss order. There are various methods to determine where to place a stop-loss order, such as putting it just above a recent swing high for a short trade, or just below a recent swing low for a long trade. Another approach is to use the super trend or average true range indicator to set the distance of the stop loss from the entry price based on market volatility. It's important to establish where your stop loss will be before entering the trade. Once you know both the entry and stop loss prices, you can calculate the appropriate position size for the trade. This helps to ensure that the risk is managed properly and the trade has a better chance of success. Why Super Trend Indicator? Why Super Trend Indicator is the best tool to set the distance of the stop loss from the entry price based on market volatility. The Super Trend Indicator is a popular technical analysis tool used to identify the trend direction and potential entry and exit points in a market. It is a type of moving average indicator that uses the average true range, or ATR, to adjust its values based on market volatility. The ATR is a measure of a market's volatility and is calculated by taking the average of the true range over a specified period. The true range is the greatest of the following: the current high minus the current low, the absolute value of the current high minus the previous close, or the absolute value of the current low minus the previous close. By incorporating the ATR into the Super Trend Indicator, it can help traders adjust their stop loss levels based on the current market volatility. When the market is more volatile, the Super Trend Indicator will widen the distance between the price and the stop loss level, which can help traders avoid being stopped out too early. The Super Trend Indicator can help traders decide where to put their stop loss levels so they can make the most money possible. This is done by using the indicator to accurately measure the right distance between the entry price and the stop loss level. Here are some examples of how the Super Trend Indicator can help traders decide where to put their stop loss levels so they can make the most money possible. This should be simple enough. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Step 4. The price target. Step 4 of your trading strategy involves setting a price target for your trade. After determining favorable conditions for a trade and setting the entry and stop loss points, it's essential to consider the profit potential. One critical factor for success in trading that should never be overlooked is setting an appropriate profit target. In real market scenarios, the method used to determine the profit target is the primary difference between a professional trader and an amateur trader. It significantly affects the long-term profits a trader can generate. Therefore, it's essential to have and consistently apply a strategy for determining profit targets in every trade. Doing so can greatly impact your profitability as a trader. Choosing a profit target requires you to calculate how much risk you're willing to take in exchange for potential reward. Your profit target should be based on measurable factors, not randomly chosen. There are several ways to set your profit target using technical indicators and other tools. However, we will show you the easiest and most objective method to determine your profit target. Using support and resistance to set profit targets. Traders often use support and resistance levels to set profit targets. Support and resistance levels are price levels where the market has historically shown a tendency to stall or reverse. Support levels are price levels at which buying interest is sufficiently strong to overcome selling pressure and prevent the price from declining further. Resistance levels are price levels at which selling pressure is sufficiently strong to overcome buying interest and prevent the price from rising further. Using support area. This chart exemplifies how support areas can be utilized to capture profits in a short position when the market is trending downwards in your favor. Once you have entered the trade, the price moves downwards until it reaches a support level where it encounters difficulty breaking below and may even reverse. In this scenario, it would be wise to take profits at the level of support where the price initially touches it. Therefore, by assessing the market's tendencies, you can establish your profit target. In addition, a trailing stop loss could also be employed to exit profitable trades. Using resistance area. Utilizing resistance areas can be advantageous for setting profit targets when you are in a long trade. In an upward trending market, key resistance areas can be identified as potential profit targets. This chart presents an illustration of how resistance levels can be employed to take profits in a long position, where prices are trending upwards in your favor. First, a long entry is made before the uptrend. Second, an area of prior resistance is observed. Third, profit target is set by using the prior resistance level. As shown in the chart, after entering the market, the price moves favorably upwards until it reaches a resistance level, where it begins to stall and even potentially reverse direction. Therefore, in this example, taking profit at the initial touch of the resistance level would be advisable. Step 5. Favorable reward to risk ratio. A favorable reward to risk ratio is one in which the potential profit of a trade significantly outweighs the potential loss or risk. A favorable ratio can vary based on the individual trader's risk tolerance, trading style, and the prevailing market conditions. In general, a reward to risk ratio of 1:2 or greater is considered favorable. This means that the potential profit should be at least twice the size of the potential loss. For example, if the risk of a trade is $100, the potential profit should be $200 or more. Having a favorable reward to risk ratio is important because it ensures that the potential reward is worth the risk. In this example, the risk is approximately 500 pips, while the profit potential is 1300 pips. This equates to a reward to risk ratio of 2:1. If the profit potential is similar to or less than the risk, it is best to avoid the trade. Although this may result in wasted effort, avoiding unfavorable trades is just as crucial to success as executing profitable ones. By consistently applying these 5 steps with discipline, you can gain the confidence and skills needed to succeed in the market. Don't miss out on the opportunity to improve your trading strategy and increase your profitability. Follow these steps and watch as your trading success grows rapidly. Here are other examples: the 5-step test of price action trading to fully understand this wonderful strategy and to make the most out of it. Ensuring that each trade passes the 5-step test is a crucial step that shouldn't be overlooked. Applying these 5 steps with discipline can yield remarkable results. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.